a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about winners and losers in the aftermath of DeepSeek drama. So last Monday, technology stocks had tumbled, led by 17% decline in the shares of Nvidia because investors began to weigh on the implications of this new AI model, which was released by Chinese startup DeepSeek. And Nvidia lost almost 600 billion in market capitalization. That was a record for a single day. And according to DeepSeek, they had developed the model at less than 6 million in 2 months. And they said that they did it leveraging existing models. So that raised many questions about tens of billions being spent by US tech giants on NVIDIA's chips and all those data centers. And the performance of the R1 model was found comparable or even better than that of competitors in some benchmarks. But some experts believe that the company is probably using more NVIDIA chips than it has disclosed. And many suspect that they might have utilized US model outputs in an unauthorized manner to improve their own models using a process which is called distillation. And Microsoft and OpenAI are investigating whether DeepSeek used data from OpenAI's models in an unauthorized manner to train their own models. And so we do not know exactly how much they spent, but most likely the models were made for much less money than AI models from leading US companies, but not as little money as the market had initially feared. So, what are the implications of all this? So, if we see increased artificial intelligence efficiency, then that could lead to reduced spending, particularly on chips, semiconductors. But we do not know about NVIDIA's chips because NVIDIA's chips will still be needed. But still, reduced spending on hardware, data centers infrastructure, and power infrastructure. So basically, as the cost of AI goes down, we could see its commoditization leading to more widespread use. So Microsoft CEO Satya Nadella, he tweeted that Jevons paradox strikes again. And Jevons paradox is basically an economic principle that says that increased efficiency in resource use can lead to increased consumption of that resource. So basically, companies that are using AI to build applications, they are going to benefit. In fact, on that day itself, we saw that Apple and Meta did well because these are going to be the users of technology. And again, it is too early to assess full implications, but decline in AI costs will generally benefit software companies, technology companies beyond the Max 7, smaller tech companies, then other companies which are using AI or building AI applications and can benefit a lot from increased use of AI, and they can improve their margins and earnings. So companies, banks, industrial companies, healthcare companies, they are going to benefit. And we have seen that investors have kind of been rotating towards these areas. So let's take a look at 3 ETFs. So the first one that I'm highlighting is the iShares software sector ETF. The ticker symbol is IGV. It has 10.5 billion in assets, charges and expense ratio of 41 basis points. Now, if you want to learn more about this ETF, you can go to the quote page on Zacks.com. You can read our research report articles using the link. You can go to iShares webpage for this ETF, see what it does. So basically, software companies in technology and communication services sectors, and looking at the holdings, you will see companies like Oracle, Salesforce, you must have heard, is building those AI agents. Even Microsoft could see increased use of its Copilot if it is able to reduce the prices. ServiceNow also using AI applications, building AI applications. So these companies could benefit. The second ETF I'm highlighting is the equal weighted Nasdaq 100 ETF. So QQQ is ultra popular. It has done very well. If you take the same index and equal weight, so basically you are moving away from top heaviness, too much concentration in the max 7, moving more towards other cheaper technology companies, which are again going to benefit from reduced AI's costs. 1.3 billion in assets, charges 35 basis points. Again, let's take a look at this ETF, Nasdaq 100 equal weight ETF, and you can look at the holdings. So you will see the same holdings, Apple, Nvidia, and Microsoft, Amazon, but their weights much different. At the time of rebalancing, they are all brought to equal weights. The third one I'm highlighting is the Vanguard Value ETF. It is the most popular with 135 billion in assets and one of the cheapest value ETF. It charges just 4 basis points. And why I like this ETF now is because it has a lot of exposure to financials, industrials, and healthcare companies. Again, all these companies are going to benefit a lot from reduced AI costs. And we have seen that value has done better than growth this year because many investors are worried about that growth stocks have become too expensive, and maybe we will see some mean reversion and value will finally come back. It has a nice dividend yield too, but let's take a look at this ETF, its portfolio. So you will see that Berkshire Hathaway, JP Morgan, Broadcom, Exxon Mobil, and United Health. These are the top holdings in the city of Walmart too. We know that JP Morgan, like the likes of JP Morgan and Walmart, United, they can really make a lot of use of AI, and they have been using AI a lot. So this will benefit companies like this. And in full disclosure, I do own all these 3 ETFs in the ETF investor portfolio that I manage. On the last slide, I have the comparative performance over the past year. And since last year's gains in the S&P 500 index were driven mainly by the Max 7, so all 3 have underperformed the S&P 500 index over the past year. The S&P 500 was up about 26%. The direction ETF is up about 11%. The value ETF and the software ETFs, those two are up between 21 and 23%. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And make sure to subscribe to our YouTube video channel so that you do not miss anything. And I will see you next week.